Hi, everybody. Welcome to our final session of Stocks Zero to Hero. Apologies for the reschedule and hosting this on a Tuesday instead of on our customary Sunday evening. That was due to another video that we had recorded on Saturday. So we wanted a little bit of gap. And I know that it's tough for some of you to attend live on a working day at 6. So what we'll do is encourage any of you that weren't able to join live for this and still have questions on the material that didn't get covered in the Q&A or the lecture. Please email us on advisory@bharosaclub.com and we'll get back to you with answers relating to this talk. Okay, let me just turn on the pointer and then we'll get started. Okay, so last time we covered updating our numbers for Britannia's fourth quarter financials that were released, and we tackled answering all the questions we had around understanding the company and its performance better. And all this knowledge has resulted in a pretty good understanding of the business, in how it makes money, and what products it sells, how its brands are positioned, what the company's strategy is, how they've been performing, what are some of the issues they're facing. So all this hard work that we've done is going to lay the foundation now for thinking about Britannia as a potential investment. And this is really where the art of stock investing comes into play. Everything that we've done up till now has been very sort of analysis based, right? We've been comparing Britannia's price to earnings ratio relative to competitors. We've been looking at its balance sheet. We've been looking at its income statement. And those things, while they're time consuming, are relatively easy to do because they are analytically driven. The art piece of investing is the hardest part to do, which is to make judgments about whether investment is good or bad, because there are no right answers. And it's all about your judgments about the future. And you're dealing with lots of uncertainty. So you're going to get a flavor of how I tried to make sense of whether Britannia was a good investment or not in the current climate. And that'll give you a flavor, not for, the right answer, because like I've been saying, right, even a good investor is wrong quite often, right? So much more important than that is figuring out how you can apply your judgment to see what you think as it relates to whether Britannia is a good investment or not. So that's really what I want our listeners to keep in mind as they go through this session. How did Sahil come to his views? What were the judgments that he made? Do I agree with them? Do I not agree with them? And what does that mean about how I should be looking at my own stocks and my own investment decisions going forward? So let's get started with this. Oh, and just one preface that I want to make before we cut into this. Obviously in times like this, right, it's very important to keep wedded to your analysis, because a lot of questions I got from my Saturday seminar were related to, the stock prices are going up, but I feel bad about the economy. What's going on? Are we having a bubble? Are we not? It's very hard to predict short-term price movements. But what you can do is think critically about the economy, about the facts facing your business, and you can make educated guesses as to how they're going to be able to deal with the economic challenges they're facing. And you're not going to be able to tell what the stock price is going to do in the next month or 2 months. But if you make enough good educated guesses that turn out to be correct, you will be able to generate good investing returns in the longer term. So call it 2, 3, 4, 5 year time period. So that's kind of another little prelude I want to give, because a lot of people get disheartened when they do all this analysis. They see the stock price move the wrong way and then they get very scared, or they get overconfident, right? It's important to keep some perspective that in the short run, stock prices are divorced from facts. So I think that prelude is very relevant in today's market. So, okay, what are we going to cover today? The final session. So we're going to put all our work together in a framework to help us make a decision. And that framework is going to revolve around first trying to figure out what we think the future looks like, right? Because when you're buying a stock, you're buying the future earnings that that company generates. You have to have some view as to what the future is going to look like. Then you need to know what the rewards of owning the stock are and what the risks of owning the stock are. And the last is the price to earnings ratio appropriate for the rewards and risks? So we're going to use that macro framework to make our decision on Britannia today. Okay, so step one, we need a view of the future. And the approach that I like using in terms of developing a view for the future is starting big picture. No company operates in a microcosm. We all operate in a macrocosm. And understanding the big picture is very important to thinking through how your company is going to deal with the future. So, for example, if you were investing in Kodak, right as digital the cameras and all were taking off, and you missed that big picture trend, no matter how good your detailed analysis was around Kodak, you missed a huge secular change away from film into digital, which would have cost you a lot of money in your investment. So similarly, that's why I like to always start at the big picture and move down towards the company when I start thinking about what the future holds for the company. So let's start with the macro. Okay, so those of you that have followed our research notes and our video on COVID and the implications for the economy will know that one of our views has been that while the developed nations are going to be able to replace the income lost due to the pandemic and the lockdowns effectively through issuing stimulus and printing money to spend to replace that income, our view is that emerging markets are really going to struggle doing that. And to a large extent, that has been borne out. So what I've shown you on this page is some Bloomberg data that was pulled just a couple of days ago, which shows you that emerging markets are indeed struggling to replace the income that's been lost. So here's India on this chart. And we can see that India, according to Bloomberg's estimates, has lost around 15%, 15 plus percent, 17% of the 2020 pre-virus GDP. And the stimulus has only been able to replace approximately 3-4% of that. So you can see there's a big chunk of missing income in the economy. So what does that mean? So the thing about the economy is that it's circular in nature. If there is less income, there is less spending. And if there's less spending, that's another person's income. So that's even less income for someone else and even less spending and so on and so forth. So there's a multiplier effect of income holes that persist in the economy. And this is going to persist in the economy as a drag until we hit an equilibrium at a lower level, unless we fill that gap with stimulus, which is still a possibility. There's always the potential the government could issue more stimulus, but that would have the effect of weakening India's currency, etc., and our credit rating, etc. So that's not something I see India being able to fully replenish. So what does that mean for what do we think about the implications of that long term for the economy? So the key punchlines: total aggregate spending will decline, right? Because there'll be holes in the economy that will not be filled. So the declines will be more pronounced for discretionary items than for required items. So what do I mean by this? Well, I mean quite simply that there's certain categories of spending where someone can cut back, right? So let's take, for example, I was thinking about upgrading my TV, right? Now, if the economy is great and income levels are high for everyone, then a lot of people are going to have the financial wherewithal to upgrade their TV, right? Now, if on the other hand, incomes are lower and people are not getting loans to buy these items, right? They're not going to be able to buy or have the desire to buy these items anymore. But on the other hand, something like food, you always need to buy food to eat, right? So declines are going to be more pronounced for categories of goods that have more discretionary nature, more optional nature in the purchase. Secondly, I think consumers are going to be in a period of deleveraging post the recovery. So we all know people that have taken salary hits, right? or lost their jobs in this COVID crisis. At least I know several that have been forced to do that. And as a result, that means that they're earning less, but their expenses have not gone down. So they've either had to dip into their savings, or they're saving less than they expected, or they're relying on debt to make it through the crisis, right? Now, post that period, there's going to be a period where consumers oversave and deleverage, right? Because they need to get their finances back in order. So spending is going to be depressed, not just for the period where it takes incomes to recover, but I think also longer as people undo all the effects of adding debt to their balance sheet, personal balance sheets. So my expectation personally, and again, this is my view, doesn't have to be everyone's view. The whole point of this is to break down my logic so you can disagree with it and come up with your own logic. But I expect consumers to become much more value focused for a prolonged period of time. And I think we really haven't seen the impact of this right now. It's too soon for people to really have felt the impacts of this yet, especially in the US, because you have the stimulus dollars masking a lot of the income hit that consumers have faced. But in India, we're seeing already the impacts of it in the migrant class, for example, and even the salaried class where people are taking income hits. So, okay, so now let's look at the sector view. So we started at the macro, now we're moving down to the sector. So FMCG is a relatively resilient sector. Why? Well, first of all, the products are relatively low priced, right? So they're affordable in the grand scheme of things. And so it's easier for a consumer, even if he's had a savings hit, to be able to buy these products. And there's also less credit dependency. No one needs to take a loan to buy, or not no one, but many fewer consumers need to rely on borrowing to fund their basic purchases, right? And also the products are staples versus discretionary, like we discussed before. So I can always delay buying a TV, but I need to eat, right? So that's why food in particular, amongst all the FMCG categories, is my personal favorite subsector in terms of resiliency. And the other points are, there's some other trends that are going on that are benefiting food, right? So food at home, because restaurants are discretionary in nature, they're not open, and people have safety concerns in eating out. So there has been an increase in eating at home as well. So my feeling is that sort of packaged food players are going to continue to benefit. And we're already seeing that in the results of Parle and Britannia, both of whom discussed very robust demand that they're seeing for their biscuits. Now, the question we need to ask ourselves is this just a blip that's going to reverse, or are these behaviors that will set in for some time? My personal view is that while people are going to want to eat out again, that's the very nature of us, that we want to celebrate once this lockdown dissolves, by very virtue of the financial condition that a lot of people are probably going to emerge from this pandemic with, my belief is that the tendency to eat at home is going to be one that continues for a while, because as the consumer is deleveraging, there's going to be migration towards the lower cost option of eating at home. So again, a personal view, one that you can dispute and argue, but that's kind of my opinion of what I see for the food sector. Okay, so the company view. So now we've explored the sector. Now let's get to the company. So Britannia's commentary thus far already validates a lot of our thinking. So we've seen 20% plus growth in Britannia in April and May. And we know that that growth has not been just restocking the shelves of Kirana stores, because we asked, I mean, not we, but the analysts asked on the call about whether that was stocking or actually secondary sales to the end customer. And Britannia said the majority of that is actual sales to customers. And Parle has also reiterated the strength that they're seeing in sales as well. So our sector view seems to be having some evidence. The question is, how long will that persist? As we discussed, I think it will persist for a while. So what are the risks for Britannia particularly? So we know that Britannia has a premium orientation in biscuits versus Parle. So is there a risk that people even trade away from premium biscuits towards Parle and value and regional branded biscuits that could be cheaper? It is possible. And that is something that definitely could happen, and I expect will happen for some segments of Britannia's customers. But in my view, that's offset by the potential that Britannia has to pick up share from people who are migrating from eating out to eating at home. So I can see this with my family already. We are eating a lot more Maggie noodles, biscuits, bread, sandwiches than we were before, because we can't eat out and we're still looking for convenient ways to prepare meals that are not very time consuming. So I expect that Britannia will probably be a net beneficiary, though maybe it will have some struggle from people migrating to value brands going forward. Okay, so that's kind of the process that I go through in terms of trying to think about the future. There's not, again, it's very art driven, right? There's a lot in there that people can disagree with and say, no, I think people are going to rebound and all these things. And that's the beauty of investing. You could be right, if you have that view, and I could be totally wrong. But we have to make judgments about what we think the most likely thing to happen is. So that's kind of what I do to develop my view of the future. Now I'm going to think about, given that future, what do I think the outlook is for the rewards of holding Britannia stock? So what I really want to build towards here is I want to understand what the next year's earnings are going to look like. So when people talk about forward PEs, in my view, this is the right way to build your forward PE. Don't rely on a consensus number that's based on some analyst views that you don't understand. Actually build that view yourself. And it's not very hard to do a reasonable job building it. And I'll show you how I went about building it in a very quick manner. That doesn't involve so much work, but still is relatively accurate, basis your assumptions. So let's understand what earnings per share growth is in the context of a company. So there's sales. So how quickly does your top line grow? Then there's something called expense leverage. So what does that mean? Expense leverage basically means, did my expenses grow slower than my sales, faster than my sales, or equal to my sales? If my sales grew faster than my expenses, then my bottom line growth will be faster than my sales growth because I was able to get leverage on the expense line. If my sales and expenses grew at the same rate, then my earnings per share growth, not including any financial leverage, which we'll discuss, will be the same as my sales growth. And if my expenses grew faster than my sales, my earnings per share growth will be slower than my sales growth. So expense leverage is another category that helps us understand how does sales growth translate into earnings growth. And the last topic that we'll need to think about with Britannia when we talk about earnings growth is financial leverage. And this basically means, did you borrow money, or are there changes in the tax rate you're paying, et cetera, et cetera. So we've seen that with Britannia, right? Even though they haven't borrowed a lot, we've seen a reduction in that tax rate that helped them deliver very strong earnings growth, even though they didn't have a lot of sales growth, right? So that's an example of how financial leverage can also increase your earnings growth potential. So now let's apply this construct to Britannia. Okay, so let's start with sales, top line. So what do we know thus far? Okay, so we know that Britannia has grown sales at 20% growth in April and May, 20% plus growth in April and May, but growth was slowing before, right? We know that it was 6% for FY20, all of FY20, and only 2% for the fourth quarter. So sales had been slow, and then COVID hit, and for all the reasons we discussed, they saw a big bounce in sales and a huge bounce in sales, right? So as I thought about sales, what I wanted to model as my base case, right, what I want to use for next year is, I was saying, let my first quarter sales assumption be 20%. Why? Well, we already know that 2 out of 3 months of that first quarter, they've grown at greater than 20%, right? One was 20% exactly, I think, and the other was around 25%. So I said, let the other one be conservatively less than 20% such that we blend into 20% growth for the first quarter. And that's another tip I'll give you. When you're doing investment analysis, always err on the side of conservatism. That's how you build in a safety margin into your investments. If you're always aggressive, then all your assumptions will add up to being hyper aggressive. And that's a great way for you not to do well in your investing. I like to use a reverse approach, which is being conservative and then resulting in conservatism on my assumptions, which hopefully the company beats. So I assume 20% growth for the first quarter. Then I assume 12% for the second quarter, 10% for the third quarter, and 10% for the fourth quarter. Because again, I believe the stay-at-home trend will persist for the full year. Not as strongly as we're seeing it, but I believe there'll be some persistence of this growth. So what does that imply for full year sales growth? That implies 13% growth for Britannia for the full year FY21. So that's what I'm modeling in. Now let's think about margins. So gross margins have been deteriorating a little bit due to commodity inflation. We've seen that in the numbers. We've also seen some OPEX leverage, meaning their overheads, they've been able to get some leverage and expand their margins and have efficiencies that they find in costs, right? So what I wanted to assume here was that I wanted to assume that gross margins stay flat at the fourth quarter level. So around 40% gross margins. Why? I believe in this price sensitive environment, it's going to be hard for Britannia to pass on any inflation they see in commodity prices. They may be forced to increase their discounting as a customer gets more and more price conscious and they compete against value brands. So I wanted to conservatively assume that they don't see any gross margin improvement, right? And actually gross margins stay at that low level that we saw in the fourth quarter. So that's what I'm modeling in. I'm also assuming a very modest amount of OPEX leverage. Why? Because Britannia said that they had cost savings planned for this year. So I want to give them some credit for that cost savings, but I'm keeping the amount relatively small. So I'm saying, let's take 50 bips of OPEX leverage, right? Very little debt leverage, right? So Britannia doesn't have a lot of financial leverage that they can take advantage of because they don't have a lot of borrowings. And the tax rate has decreased in the past, but I don't expect the tax rate to decrease in the future. So I'm not assuming any financial leverage for Britannia. So if I just do a very simple calculation and work through these numbers on the P&L, so what I did is I grew my income, I held my gross margins flat at 40%, and I gave the benefit of some operating margin expansion to offset some of that gross margin decline. And what that translated to was an earnings per share number of 69 rupees and 14 paisa, right? Which was earnings per share growth of 13%, 13.5%, off of 13% revenue growth. This is pretty conservative. If you see a company generally growing at 13% top line, you would expect earnings. 1 second. Can you guys hear me? Sorry, I just saw that a few people are having trouble hearing me.
Voice is going a little.
Anita, can you just tell me if I'm coming through?
It's fine.
Sorry?
It's fine now.
It's fine? Okay. Okay, great. Let me know if anyone has trouble.
No, it's back.
Mama, just interrupt and check. Okay, 1 second. I'm just going to try to open the door. Better? Hello?
Yeah.
Better? Okay. So where should I start from?
No, you were okay up to 13% earnings per share.
Okay. Okay, so 13% earnings per share growth, I feel, is pretty conservative on a 13% sales assumption. So 13% revenue assumption may look aggressive, but basis my view of a shift towards eat at home, basis what we've seen in the first quarter of Britannia's numbers thus far, I believe it's a relatively base case view. Could they miss this? Yes, they could miss this. But I feel relatively good about the 13% sales growth number, but I'll keep updating my analysis as facts change. And you'll see that in 2019, they were able to do 12% revenue growth without the benefit of this massive shift to eating at home. And what I do feel is appropriately conservative is the profit, right? So I'm only assuming a 13% earnings per share growth number on a 13% revenue growth number. Okay. So now let's do a little math basis that EPS, right? So let's calculate our forward PE for Britannia. So one thing I wanted to do is that Britannia has a lot of cash on its balance sheet. So when I buy a share of Britannia, I'm not just getting the earnings, I'm also getting a share of the cash they have on their balance sheet. So, and investments they have on their balance sheet, right? So what I did is I calculated the per share value of those investments, and I want to subtract that from the price that I'm paying for Britannia to see what my real PE is for the company, right? Basically saying, okay, some of this price is related to buying the investments on the balance sheet, and some of the price is related to buying the actual earnings. That's the logic behind it. So how did I do that? So I calculated the investments Britannia had. I subtracted out the borrowings that they owe other people. So net, they had 3,075 crores of investments. And on 24 crore shares, that works out to a value of 130 rupees. Okay. Now, I took a haircut to that number because, as we know, Britannia is also lending money to group companies and other corporates and all these things. So it's not as good and safe as just pure cash. So I gave an 80% haircut, again, very conservative, to that cash number. So I said, let's say that 100 rupees of the share price is recoverable in the cash in the company. So my true forward PE adjusted for that cash and investments is the 3428 price minus the 100 in cash divided by the 69.14 EPS that I calculated on the last slide. That gives me a PE of 48 times. This compares to a market average PE of 20 times. What the heck is going on, right? That's a really high PE, right? Why does it trade so expensively, right? And oftentimes we're used to seeing companies trade at high PEs because of high growth prospects. So DMart is an example, right? Everyone thinks DMart is going to open up lots of stores and keep gaining share in retail. And so people are willing to pay high PEs for that. What about Britannia? I mean, I don't think it's growing EPS that fast, right? So why are people willing to pay such a high PE for Britannia? And like I said, the answer comes to risk, because there are two components, right, of finance that we look to balance: the risk and reward. So if something has very low risk, then we are willing to part with some of the reward in the form of the earnings yield of the stock. So we're willing to pay a higher PE for that stock. So let's understand the risks, right? Why is Britannia such a low risk company? Well, let's look at what's happened, right? Macro risks. We are facing a huge economic calamity, right? And Britannia has actually grown their sales in this time, and not just grown their sales, seen 20% growth in their sales, right? So it's in a very secure part of the economy. If damage is very bad, you could see some trade down, but as we discussed, even then it will still be outperforming lots of other sectors of the economy, right? If you have depressed consumer spending, are people going to be able to buy cars? Are they going to be able to buy two-wheelers? Are they going to be able to buy TVs like they were before? Maybe not. But are they going to be able to buy food? Probably. So on the macro side, Britannia is very insulated. On the competitive risks, Britannia has very strong market share. Like we learned in our analysis of the company, it has 33% market share in both biscuits and bread, its two largest categories. So Britannia has a dominant brand. Could it face some competitive pressures? Absolutely it could, but we all know that Britannia is going to be around and still selling well, relatively well in the next year, 2 years, 3 years, 4 years, even 10 years. You could underwrite with Britannia. Can you say that with the same confidence about any other product, even Apple? Are we sure that people are going to be buying iPhones, the next iPhone model? We're not sure. But we're sure people are going to buy bread, biscuits, and they're going to tend to buy Britannia products. So even on the competitive risks, companies like Britannia have a lot less risk than a lot of other companies. Now let's think about the financial and company related risks. We saw Britannia's balance sheet. It's very, very low in liabilities. So they're not taking a lot of risk on their balance sheet. Now, if you think about some other companies, right? Like let's think of banks. Banks take a lot of risk in terms of leverage, financial leverage. They're borrowing lots of money from depositors and they're lending those out to other people, and they're keeping very low equity reserves. So if they start seeing loan losses, etc., their balance sheets get into trouble. We don't have those risks at Britannia. So Britannia has an exceptionally low amount of uncertainty and risk associated with it. We don't have fears that Britannia is going to go out of business like we do with a lot of other companies if you face financial stress. So that's why FMCG companies trade at such high PE multiples. It's not because of the growth, it's because they're almost like bonds in the sense that these assets, investors are willing to bet that they're going to be around for a very, very long time. Okay, so we understand now why it has a high PE, right? But is 50 times PE a good deal? So we already looked at relative valuations with other FMCGs, and that looked favorable to me. Just to remind you, it showed that Britannia was trading at a little below the average valuation of the companies that we looked at. I think that actually when I look at Britannia versus some of those peers like Dabur and HUL, for example, I feel like Britannia's product categories are stronger than even HUL's in an economic environment like this. I think that, personal care products, people are not showering more these days or taking better care of themselves these days, but they are eating more at home, right? So Britannia is facing a tailwind that these companies are not. Nestle apart, I think Britannia probably has the best product category exposure of the companies we looked at, in my opinion. So on a relative basis, I feel like Britannia actually deserves to trade at a premium to some of the FMCG companies that we've looked at, just given its product categories. But what about on an absolute basis? One of the traps we sometimes fall for in the market is we look at where other things are trading and then make our decisions based on that, right? And this was the problem in the internet bubble. All internet stocks were trading at ridiculous valuations. So if we just looked at those and said, hey, Amazon is trading at this, and so then pets.com also deserves to trade at this price. We can lose sight of reality doing it that way. So what about on an absolute basis? How do we think about how to price Britannia correctly? So I'm going to walk you through something a little bit theoretical. Don't worry. It's actually pretty easy to understand. And when I do an advanced course, I'll actually work through how this formula is derived and some of the more gritty aspects of it. But this is going to help you understand the mathematics of theoretically deriving the price of Britannia. And this will give you some theoretical underpinnings to get you comfortable with a 50 times PE, to see what do you need to believe for the theory to justify your stock price. That's what we're doing in this analysis. So I'm using something called the Gordon growth model, and it works well for a certain class of companies. A class of companies like Britannia that are mature, they're bond-like companies, pretty steady eddy businesses, tend to have stable growth, not all over the place. They have profitable operations at generating positive cash flow, etc. So the Gordon growth model takes a few inputs. The first is the rate you expect earnings to grow into the future, right? Then the rate of return an investor would require from holding the stock. This basically means if I buy Britannia, what is my return expectation of holding that stock? Do I want a 12% return? Do I want a 15% return? How is the average investor going to price Britannia? And we got to understand what that's a function of, right? If a stock is riskier and has more uncertainty, then that's going to be a higher number. An investor is not going to invest in a risky stock unless he's expecting that risky stock to give him a 20% return or something like that, right? And the important thing to realize here is this is a relative riskiness, right? So if an investor has lots of options to put his money in, then it's very competitive, and that's going to drive the required holdings return from holding the stock up. But if there are not that many great investment options out there, he may be willing to take a low return on the stock, right? So this gives you an idea of supply and demand basically for the stock. So it'll become clearer when we walk through the numbers. Then it takes the 1 year forward earnings of the stock, your estimate of the 1 year forward earnings of the stock, which we just calculated for Britannia. And what this formula does is it back solves to the appropriate price for the stock given those inputs. And the formula is very easy to calculate, okay? And so if you have a company that looks like Britannia, you can use this formula to calculate what the theoretical price of the stock should be. Before we go into the formula, I just want to tell you why this works, right? We discussed in the first class itself that when you buy a stock, what are you buying? You're buying the future earnings of that stock. Now, if I don't want to rely on ever selling that stock, how do I value that company, right? Basically, I need to sum up all the earnings that that company generates forever, right? And I need to discount them back to today's price, add them all up, and that's what my theoretical value of a stock is. So I'll cover this in more detail in the advanced sessions on doing discounted cash flow analysis and the Gordon growth model and all these things. But just as a intermediate stock investor, the way to understand this is that, look, I don't know what an investor is going to be willing to pay for Britannia 2 years, 3 years down the line, right? We don't know what PE multiple it's going to trade at. But if I ignore that and I want to know what's the price of the stock just based on the earnings it generates, this is how I calculate it. Okay, so the formula is as follows. The price of the stock equals the earnings, the forward earnings, divided by the returns that that an investor would expect from holding the stock minus the earnings growth rate, okay? So in an advanced course, I'll walk you through the derivation and all. It's basically derived from the infinite series calculation for a geometric series. But let's apply this to Britannia. Okay, so I know what our next year earnings is. How quickly do we expect earnings to grow long term? There's no right answer here, right? So I'll tell you how I go about doing analysis like this. And then also, what do I think an investor will demand on returns for Britannia, right? And that's going to be related to the riskiness. Again, there's no precise answer. So what I tend to do is I tend to look at a range of values, okay? So here I've shown you a chart that shows you for different values of long-term earnings growth rates, right? And different values of return expectations from investors, what the implied share price of Britannia is, right? And the ones in green that you can see here are ones that are above today's trading price. So how does this help me? It helps me understand what I need to believe that Britannia is capable of doing in the future in order for my share price to be justified, right? So this chart very clearly tells me that if I think Britannia is a buy, right, then the fair value of the stock has to be above current prices, which means that I need to believe that my earnings growth is approximately 10% or higher long term. And I need to believe that Britannia is, any investor is willing to hold Britannia for a, let's say, 11 to 12-ish% return, and they'll be satisfied with an 11 to 12% return. Now, why would they be willing to only receive an 11 to 12% return for Britannia? Why wouldn't it be higher? Everyone wants a 20% return, right? Well, Britannia is such a safe stock. Remember, even when we had an economic disaster, the company grew its sales. That people will be willing to hold Britannia for a lower return than they would be willing to hold even HDFC Bank, because HDFC Bank is a riskier business model than Britannia. So that's why I picked these values, right? And so as you get more experience, you're going to get better and better at putting these numbers in. But a good way to think about it is ask yourself questions, right? What is an average stock return? Is my company higher risk or lower risk than average? What does an FD pay me? What does a corporate bond pay me? That'll help you think through what the right numbers to look at here are. But with my judgment, I decided to look at these values in terms of the perceived riskiness that I had of Britannia. And so now, is Britannia a good buy, right? So the key questions I was asking myself are, do I think it can grow earnings at 10% a year long term? And long term I defined as 5+ years. Do you think that 11 to 12% is a fair approximation of the return an investor would expect in the shares? I did think that was fair. And the answer to these questions are going to depend a lot on your view of the current environment. Are there better opportunities, right? 11 to 12% in a very poor performing market where there's going to be a lot of financial pain and all is a very good return. In a market where there's going to be a strong rebound back to peak productivity levels of the economy, it would not be a good return, right? And also with your perception of the relative risk, if you think the risks are low and that we're going to see a V-shaped recovery and people are going to generally go back to where they were pre-COVID, then the answer would be very different, right? So this again comes back to the art of investing. So my view, so I basis all the analysis that we've done and the parameters we've walked through, etc. Britannia is not a screaming buy to me. It's not something like UPL. If you guys are members and saw the research note, UPL to me was very cheap relative to what I thought the long-term prospects were for the company. That doesn't mean that I feel like the risk is higher in a UPL. So therefore a lot of my assumptions could go wrong with UPL, right? There has a lot of debt. It could have trouble paying that debt back. Britannia doesn't have all those risks. So Britannia is not a screaming buy to me, but it's close to fair value in my opinion, in a market that I believe is not pricing in adequate risk right now of long-term economic damage from the pandemic. So to me, I'm not seeing a lot of screaming buys in the market on my analysis. Britannia is close to fair value, maybe a little bit below or above fair value here or there, but it's pretty close to fair value. And to me, it's a good store of value and something that I want to have some exposure to, because I feel like in this environment with the risks we're facing, in all, I think that having some allocation to Britannia makes sense. So in my judgment, that's the kind of conclusion I reached on Britannia. Again, it's an art, not a science. You guys can disagree with the conclusions, and that's the beauty of investing. You may be right, I may be wrong, it's all about judgments and where we think the future is going. So I hope this was a useful series for you guys. And that kind of brings us to our conclusion. I'll give you a flavor of how judgments are made about stocks and how analysis is done and how much is up for debate. And that's the beauty of investing. You can never rest on your laurels. There are no perfect answers, and everyone's on an even playing field. So why don't we open it up for Q&A?
Okay, so the first question is, why is India's income gap much higher than other countries?
So good question. So it's not that COVID hit us harder than other countries. That's not the reason. COVID hit everyone pretty hard. The difference is that developed nations are able to replace holes in their economy more effectively through fiscal stimulus. And the reason for that is that their credit ratings are higher. They're able to sell more debt in the capital markets. So the government is able to replace some of that lost income. In the case of India, India wasn't able to replace a lot of that income and has not been able to do it thus far. They may come out with more stimulus, and I hope they do because we need it as a country. But I do not expect they're going to be able to spend the amount required to fully bridge that income gap without seriously jeopardizing the credit rating of the country. So India has a challenge, and not just India, a lot of developing nations have this challenge that they haven't got the financial reputation to be able to plug these holes quickly by just printing money. That doesn't mean we're not going to be able to recover. In my view, we're absolutely going to recover. It's just going to take us a little longer, in my view, than some of the developed nations.
No, it's the lost income for India was much higher than other countries. Why is that? Not the gap.
Oh, well, I don't think the lost income was. I mean, maybe on that chart, it shows that the lost income was. Yeah, you're right. That does show even the income gap is higher. Good question. Um, I don't know. Maybe this is saying in some ways I haven't looked at the data screens, but we'd have to think about that. Why the coronavirus disproportionately hit India's economy harder than other nations. But regardless, even if it hit equally hard as the others, even the fiscal stimulus is still well below even 10%, which is the kind of level that it hit most people. I think we had a stricter lockdown, right? So I think that's one reason. Our lockdown was very, very strict. And I think that may have cost us more. What?
Yeah, I think you're correct there.
Yeah.
We had a stricter lockdown.
Okay, so from the Bloomberg slide, economies like China have a larger stimulus. Then how much the GDP is expected to be hit, hence net positive. Do you think this will trickle down to countries like India and have a positive effect for such countries?
So yes, it could. Absolutely. We live in an interconnected economy. So it's a good question. You could see some of those dollars flood into the global market. But I still think if you look at the net stimulus and the net income lost globally, I think there'll still be a sizable gap in terms of the world economy. I haven't done the math myself. That's just my speculation, that we're not going to be able to fully plug the hole that we see globally. So will the excess stimulus in some countries go towards plugging some of the holes that you see in other regions that were not able to spend? Absolutely, you could see that, but I don't see it fully bridging that gap. And also stimulus is not spent 100% efficiently. And you're seeing a lot of this in the US. The US also fully plugged its income gap and more, right? But you're seeing a lot of leakage of stimulus dollars in terms of fraud, in terms of money going into the stock market and not circulating back into the economy. If you see a lot of what's going on in the stock market in the US, a lot of the price action has been driven by people taking their stimulus checks and routing it into the stock market. Now that doesn't directly trickle into the economy directly, right? Once the person sells the stock and then eventually spends it, it will come back to the economy, but it'll take time, right?
Okay, so in the haircut slide where you were, calculating the haircut, you gave a 20% haircut, not an 80% haircut, I think.
Correct. Yes. I misspoke. I was not intending to Correct. I took 80% of the value, not an 80% haircut. Correct.
Okay,
That's
okay.
a typo. Yeah.
Got it, got it.
But that's what I meant to do. I didn't want to take such a large discount to the
Okay.
value.
Would you regard this stock as a defensive stock in a portfolio?
I would regard the, this is a tricky question. So that question always needs the corollary of at this price, right? There's nothing about Britannia's stock per se that means it's defensive at any price, right? Because as we all know, you can overpay for any stock. So the 1950s, 60s in the US, there was something called the Nifty 50, which has no relation to the Nifty in India. But this was a group of stocks that people believed was riskless. It had companies like Coca-Cola in it and General Electric and really, really large companies. And people believed that these stocks were so defensive that you could pay any PE multiple to them and they made sense. So these things traded at absurd valuations, right? Now those stocks eventually cratered, right? And it took a very long time for them to recover from people that overpaid for those stocks. So do I think Britannia is a defensive business? Yes. Do I think Britannia is defensive at these prices? I think it is defensive relatively because I'm seeing a lot of stocks that are too expensive, but on an absolute basis, it's fairly priced in my point of view. You know, it's fairly priced and it's a good store of value, but I don't view it as something that is like super cheap and there's, you know, no downside risk. I think the biggest risk with Britannia, holding Britannia, is PE multiple contraction, which could happen oddly if you see a very quick recovery and the economy bounces back much quicker than people thought. You could see a lot of rotation out of FMCG into sectors of the economy that deliver quicker earnings growth. And that got hit harder. So oddly, that's the scenario where I think Britannia would underperform.
Got it. So have you looked at Britannia's holding company, Bombay Burma? Does it make sense to buy the holding company rather than Britannia, as it looks like it's available at a much lesser valuation?
That's a very good question. I have not looked at the holdco. I'd have to study it to look at it. There could be reasons that the holdco is trading at a discount. So there could be leverage sitting at the holdco, and generally holding companies tend to trade at discounts, but I'll take a look at it and get back to the listener.
Yeah. All right. I think that's it for now. I think this was a great series. Thank you so much. And thank you everyone for, coming to all these sessions.
Great.